But I can tell you that cash flow right now is $5,400 a month. If I could find 20 more like that, I would love to do it. And I almost didn't do the deal.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
Hello and welcome to episode 34. Last week, I had a great conversation with Josh Sterling, owner of Epic Property Management and a real estate investor himself. And Josh and I spent a good amount of time talking about his early portfolio, how he started buying single-family homes back in 2009 in the southeast Michigan area. This week, we're going to talk more about the growth of his portfolio, going from 20 to 24 units to 160 units where he is today. And we're going to talk about multifamily investing as well as Josh's management company, Epic Property Management. So Josh, thank you very much for coming back and talking to us this week.
Thanks for having me again.
I want to pick up where we left off because you had grown your portfolio to, I think you said 20 to 24 units, all single families?
Yeah, I think we were in that 20, 22 range, somewhere around there.
And then you found a deal for 24 units, a land contract, a multifamily that was, 40% occupied, I think you said?
I think it was 42% occupied the day we took over, yeah.
Starting with the deal itself, how did you find this deal and how did you take it down?
So I found it through a commercial broker. I happened to, through a friend of a friend, meet a commercial broker, and he had a little bit of an aviation background, and so we kind of hit it off. Airplane guys tend to flock together. So became pretty much a friend of mine the first couple of years in investing, and he was selling big apartment deals, so I didn't see there was anything he could do for me at the time. But he came across this little 24-unit property. It was in our market, and he brought it to us, and unfortunately, we couldn't get a deal put together. The seller, this was back in probably about early 2012 when he first brought it to us, and the seller didn't thought that he could improve the property on his own. After he listed it and everything for sale with this broker, thought that, you know what, I can actually turn this around. I see the market coming back, and it was starting to show some signs of life. So nothing happened.
And this was the seller. He was a guy who was probably managing the property himself.
They were self-managing. Yeah, they had bought the property in 2007, and as you know, multifamily prices are not dependent on comps or anything. But they had paid a lot more for the property than I was paying for it. They had paid about $900,000 for it in 2007 or 2006, and we were talking in the mid 500 range when he first brought it to me. I think it was about 550 or so. So we only had when he first brought this to me, we might have only had 8 or 10 units. We didn't have that many single families, and we were going to try to put this deal together. But again, the seller kind of decided not to go through with it. So we just left the door open. We just said, okay, when you're ready, bring it back to us. And about a year and a half after that, we didn't close until October of 2013, Halloween of 2013. We closed on it. So it was, I think, about a year and a half. We'd forgotten about it. We'd moved on, and we were up to about the 22 or so single families. And out of the blue, the seller found my wife. It turned out the son had gone to college or had gone to high school with my wife, and found my wife on Facebook and said, "Hey, are you guys still interested in this apartment building? We need to sell this thing now." And so we said, "Of course we're still interested." So that's when the deal came about. But we had to let it season for a year and a half. And obviously the reason they now wanted to sell it was doing worse than original. I think when we originally looked at it, it was in the mid 60s or low 70s occupancy. When we actually bought it, it was at 42.
Do you have a sense, and this is interesting because I certainly bought a lot of properties, a lot of multifamilies during that period from owners and operators who really didn't know how to manage a property correctly.
Right.
Do you have a sense of what he was doing wrong to create this problem?
So first, when he brought this to us, I had to ask myself a question. I had to say, okay, this property is 42% occupancy. That's the facts. It's obviously not doing well. It's not making money today. He's behind 3 years on his taxes. I don't want to be in that situation. So why is it that way? So for me, I said, okay, is it management or is it the property? Is this property in such a bad location that nobody wants to rent from it, or rent here? Is it in a location, or is it in a condition that the units are so bad that people just don't want to rent? Is it something I can change or something I can't? Is it management that they're not professionally managing this building enough, or they're not showing the units as regularly as they should, or what is the problem? So I had to take basically a flyer on this and say, I think I can do a better job than he did, because I can't run a property at 42% occupancy and make money. So that was the debate, and time will tell the answer, right? And so over time, within 12 months, we were at 100% occupancy. So that proved it right there. What was the problem?
Wow. So it was obviously a management problem. Was it just he didn't know how to market the property?
It was a management, and it was a willingness to invest. So one thing that has always set me apart from for lack of a better word, the slumlords that I've come across. Yeah, everyone knows they're out there. They kind of give us all a bad name. One thing that set me apart from that is I've always had taken this pride in our properties. I can't, in good conscience, rent a property that I wouldn't live in myself. Even to this day, with our multifamily units and everything we do, we go in and we rehab everything. And so I think his biggest problem, I think the property attracts the tenant. Management is key. Management and the way you manage it definitely is that icing on the cake there. But the property has to be a quality property, and he wasn't investing the money needed into that property to maintain it. And so I'm sure the economy didn't help him, but when people maybe started losing jobs and were having trouble paying rent, he obviously lost some income there. But the fact that he wasn't putting in the funds to rehab it and get this property up to par caused him to get on this downward spiral where every tenant that moved out was less money, and each time he had less money coming in each month, he did less repairs and just downward spiral. Literally the only thing that we did, besides maybe have a little bit more professional management, and it was still just myself and my wife doing some showings, but the only thing we did was we put about $100,000 instantly into the building, just started upgrading units and upgrading common areas, and we're at 100% occupancy.
Wow. So it didn't take much.
It took, well, it was a lot. There was a lot that went into that, but that's the tools that we used. We used some capital. We borrowed from single families we had. We might have even been still using a little bit of creative financing at that point, some lines of credit and 0% cards. And I mean, we were doing whatever we needed to do to grow this. We were committed, but we would go out there. If someone called for a showing, that was another key thing that they were doing wrong, is they lived an hour and a half from the property. And if someone wanted to show it, they would say, well, we can show it next Wednesday at 3 p.m. And that tenant's going to go find something else.
Wow.
So that hurt them. But also when that tenant got there, if they did come out for that showing that they would block, the unit would be falling apart. So we just started upgrading them, just like our model had started to develop on the single family houses. And the nice thing with multifamily was that I realized really quickly what that did to the value of the building. So some real quick numbers on that. I love the number side of it. We were renting those units for between $525 and $550 when they were what we call base model unit.
Were these one bedroom, two bedrooms?
Two bedrooms. Yeah. Well, there are 22 two bedrooms and 2 one bedrooms. So basically all the 2 bedrooms there. We're renting for about $550 a month. They were in pretty bad shape. They were probably original 1974 built, cabinets and, one color, one tone paint, the slab doors, just pretty bad property. So they'd get $550 for one of those, and that's what almost every unit was in there. We would go in, and it ended up costing me about $8,000 per unit. So we went in and we did like 4 of the vacants right off the bat. But we would go in and we would put new kitchen, so new cabinets, countertops. We would tile the floors, just some upgrades.
Now, were you doing granite countertops and stainless steel appliances?
We weren't quite doing that level. As much as I love that level, that was a little hard to justify it at the rents even that we knew we could get. So we were doing it was a nicer, higher level Formica that had like a bell nose curve on the countertop. They actually look really good, really, really nice. But it was a little bit less expensive than granite. But we were doing like tile floors and changing 3-tone paints and changing all the doors out and all the bathroom vanities and whatnot, new cabinets. So the properties looked absolutely awesome when they're done. It's still one of my favorite style remodels we do for apartments. It was so easy to do because everything was bad. Those are easy remodels when you can just gut and replace. When you have to debate about, do I save this, do I not save this, that's where it's tougher, I find. But anyways, the numbers on it are what are so fascinating to me. So if we rehab that unit, we could rent that unit for, at the time, I think we'd go to maybe $675. So we'd get about another $125 to $150 a month, right? So let's just, for simplicity, say we only got an extra $100 a month for rehabbing that unit. So if you get $100 a month extra in rent for rehabbing the unit, I think you can all agree with me that your expenses didn't go up at all. Yes, you put some capital, you invested in the property, but your expenses every month did not go up from making that a nicer unit, right? So that $100 per month is $1,200 per year, right? So in additional cash flow we get. For one, it's easier to rent the property too, but we're getting now $1,200 more a month or more a year per unit, right? So if you can follow me there, $100 a month, $1,200 a year. So at the way you value multifamily, and I can get into cap rate if you want, but we were just valuing it at a 10 cap. That was a real simple number. So at a 10 cap, every $1,200 per year in net operating income you add adds $12,000, right? It's a 10-time multiplier, adds $12,000 in building value, right? So it cost me $8,000 to do that remodel, but my building was worth $12,000 more for every one I did. So it was easier to rent. It was just a no-brainer. So we just did that to every unit we could get our hands on. And we went through the entire building and little by little over a couple year period did virtually every unit.
Yeah, wow. You made a great point that I want to make sure people understand, and I teach this in the class I do for the RPOA, which is on advanced financial analysis. When you're in the commercial world, and that's 5 units or more, a property with 5 units or more, that's a commercial property. Your value is based on the net operating income, and the rule of thumb is for every dollar you increase the income, the net operating income, you add $10 in value to the property. So what you just said there, by increasing your rents by $100 a month, increases your yearly income by $1,200. Multiply that by 10, you've added $12,000 in value to the property.
And the beauty of that's on each unit. So if you multiply that across 24 units, now you've added some real value to a building, which is exactly the process we followed through that.
Yeah, you've added several $100,000 in value, which you can then take out if you do a cash out refi.
Which is exactly what we did.
Yeah, so let's go back and talk about the numbers, because I know last week you told it, but I want to say it again. You bought this property for how much?
We bought it for $514,900.
$514,900 on a land contract?
Land contract, yes, and I think we put $120,000 down.
And the reason you had to do a land contract is because no bank is going to touch this property if it's only 40% occupied.
Right. Luckily, the sellers had enough equity. They had essentially, the sellers, their story was they had made some money in the medical industry and wanted to get into investing and just put a bunch of money into this property. So they had enough equity. They were able to sell it on land contract too, which worked.
Are you still on that land contract? I mean, what were the terms, and did you cash out refi at some point?
I was a little worried going into it, and I always try to look at what's the worst case scenario here. So on this property, we negotiated that I knew I wouldn't make money right off the bat, and I knew it needed a fair amount of CapEx, a fair amount of investment to get up to speed here, to get running. So I negotiated in 6 months with no payments, which was great because then I didn't have that drain on the money I needed to be putting in the building going to the owner. And I negotiated in a 5-year balloon on the land contract because I thought this is probably going to take me 3 years or so to get stabilized till a bank will finance it, and pay off the land contract for me, get real permanent financing in place. And I thought I want a little bit of a cushion here. So we negotiated in this longer balloon payment. It ended up not taking nearly that long. We were able to refinance and pull out all of our capital and then some 14 months in, and we got an appraisal on the building at $900,000, which is right where they bought it for back in 2007.
Wow, so you got it back up to where they started.
Right. So although I don't necessarily agree with how some appraisals come about, it was just kind of ironic that it came up to that.
Yeah, and you what was the interest rate you were paying on that land contract?
It was in the 5-6%. It was a fair rate. It wasn't anything crazy. And it was amortized over 30 years. We did a longer term on that. So the payments weren't killing us, but being able to refinance that and pull out my capital that I'd put into it, actually probably and then extra capital on top because we'd added some value there, was really, really nice. And then it was even a lower rate after that.
Yeah, so let's dig into that a little deeper because you paid what, 500? Did you say 516,000?
It was 514.9, so call it 515 grand.
515. Yeah. You put another $100,000 in on top of that for rehab.
Yeah, if you add it up in that first 14 months, I think it was more like 125 or 130 that we had, because we were doing this rehab as it progressed, so it wasn't all at once. It wasn't like we put the down payment and then we dumped another 100 and something into it. It was like, $8,000 here, $4,000 there, $2,000 there, but it just added up over that 14 months.
The Rental Property Owner and Real Estate Investor podcast is brought to you by the Rental Property Owner Association, providing services and benefits to Michigan investors for over 48 years. The RPOA benefits and services include investor networking, property management and investment forums, tenant screening services, free limited legal advice, education, national and local discounts, and lobbying for the industry. Receive a 50% discount on your first-time membership with the RPOA by calling 616-454-3385 Monday through Friday and mention this podcast. Once again, that's 616-454-3385. The RPOA, where over 1,300 Michigan landlords and real estate investors go for success.
And I suppose you were probably putting your cash flow back into the property as well.
Oh, we were putting that cash flow. Again, we were still living. I was probably still living with my wife's mom at the time. I mean, this was we were living so cheaply and just investing everything we had. I'm talking, there's no new cars, we're not really going out to dinners. We're living cheap. We're putting everything we've got into this business in order to grow it to what we want it to become.
All right. And you bought it for $515. You put about $130 into it, so you had altogether about $650,000 into this property. Land contract. The actual cash out of pocket was probably closer to $225.
Yeah, somewhere in that range
altogether.
Right.
Yep. You within 14 months, you got the value up to $900,000.
Yes.
You did a cash out refi. And you said you paid yourself back that $200 and so dollars, $240.
Yeah, so we did a cash out refi, paid off the land contract, obviously, and then the bank that we work with on that one gave us 80% financing on that. So there's always some loan costs and appraisal costs in there, but when it was all said and done, we had a big check to work with. I think the check we walked out of closing with was in the $225, $230 range.
So pretty much the money that you would put into the deal out of your pocket, you got back 14 months later.
Right, and I think it was actually a touch more than that.
So, with a little bit of profit on top of it.
Right, and I still own the building, and it was cash flowing excellent because we had increased a bunch of those rents.
Yeah. So, and this is always the goal. I mean, what you did is a grand slam. You got all your money back out. You have no money into this property at all of your own. There's no money of your own. You're just purely the bank's money.
Yep.
Your tenants are paying down the mortgage that you have. The cash flow, and I assume you're getting cash flow now.
Oh, it was good. The cash flow, it's actually, to this day, that is my best performing asset right there, that property, as we sit right here today.
Yeah, and that cash flow, that's money going into your pocket. You have no money in the deal. You can't even calculate the return on that cash flow.
You can't, but I can tell you that cash flow right now is $5,400 a month right now today.
Wow, so that's cash flow after you pay all your expenses
on everything. It's a awesome deal. If I could find 20 more like that, I would love to do it. And I almost didn't do the deal. So
and now, so you're saying cash flow is $5,400 a month,
right?
So you're over $60,000 a year you're making off this one property.
And our rents have come up a little bit over time. So we're getting now $715 for a lot of the units. So that helps every time you increase rents a little bit. We're getting we've increased simple things like laundry income on the property. We got rid of the contract laundry that they had and put our own in, and that produces a few $100s in profit a month right there. Small things like that start to add up too. So we've got that cash flow. That building is really doing well.
Yeah. Did you buy your own laundry machines?
We did. We found a nice little program where you can buy them with 3 year 0% financing. So if you can get 0% financing, I figured why pay cash, and we let the laundry equipment pay for itself, and then it's profitable after that.
Yeah, I mean that laundry's on a smaller property like that. On my larger properties, we use we rent the machines and we split the take 50-50. But on the smaller properties, if you can buy your own coin operated machines, you're going to get a payback in a year or two, and it's going to add so much value to your property.
That helps right there. And then another thing is the ones that were in there were kind of old, and even though they were working, they didn't look good, and tenants love new things like that. So the tenants, even though we were making money now off of this laundry equipment, they loved the fact that the new owners came in and put brand new laundry equipment in. The new owners came in and tiled the floors in the laundry room and the common areas. So when we do those upgrades, laundry is my favorite, because the tenants love you for doing something to the building, and I love it that we make money off of it. So that's an easy, great upgrade to do right there.
Yeah, and it's a great signal to the tenants that the new ownership is going to take care of the property.
Right.
I mean, it sends a great message.
In our and we've done that with our other multifamily too, and we plan to do it with all that we purchase. Our other large multifamily, we knew a little more what we were doing. So in our change of management letter we send out, the very first paragraph says that your property is under new management and new ownership, and you can expect in the coming months to see various improvements to the property, including new laundry equipment, new interior carpeting in the hallways, new landscaping and things like that. You tell the people right off the bat, here's what I'm going to be giving to you. And it just sets that tone that we want to take care of you, and we want to take care of this property.
Yeah, that's great. You send the right message. You go in strong, which is something I believe in. When you take over a property, you always want to go in strong and make sure you have the funds to improve the property the way it needs to be improved.
Right.
But what you achieved is kind of like the holy grail of real estate investing. It's an infinite return. The money that you put into the deal, you got back within 14 months. Everything else is gravy.
That's the deals that I'm looking for when we syndicate now, when we're looking for bringing other investors in. Because if you have other investors in that deal, you can get them their capital back. Imagine if you can get them all of their capital back in 14 months, and then they're still making a return on that, potentially infinitely, depending on the structure here, right? But this could be a really great deal to bring another investor in on too. So that's the kind of stuff we're looking for nowadays, that we're out there when we get these multifamily deals across our desk. Is that something that we can not only do well for ourselves, but let our investors share in some of that opportunity and some of that upside with us? Yeah,
definitely. I mean, you've done it. This is not just a theoretical thing. You've actually done it, and you've got this property to show for it. How many units are you up to at this point?
So this was, I'm going to call it 50 or 48. We were right in there at about that 50 mark.
Okay, and most of the property aside, this was a 24 unit that you had bought, but everything else was what, single family?
Single families, yeah.
Okay, and you talked last week about reaching those different plateaus, and one of those plateaus is money. At some point, you run out of money. So do you stop investing, or do you start using other people's money? And then another plateau that you mentioned was management. If you're self-managing, you reach a point where you can't take on any more units. Where were you at this point?
We hadn't really ventured into the realm of private money much, besides maybe a small investment from friends or family. I definitely hadn't gone out and networked enough that we were funding these deals with private money or syndicating them yet or anything like that. But what we had found on the money plateau was that banks were still lending to us via these portfolio loans, these blanket loans. And so that was what allowed us to have the funds to do this deal, this 24-unit deal, and actually for quite a few deals going forward after this. Management, this was where it really changed gears for me. 1 unit's easy to manage yourself. 5 isn't too bad. 15, 20, you're starting to have a little bit of a workload. 48 units by yourself with a full-time job is absolutely insane. And that's what we did. We were hair on fire, emergency every day. Just everything we did was just absolutely just overwhelming. I just didn't have time for it. Phones were ringing off the hook. I couldn't get out to show units. I mean, I was way beyond needing someone else to come in and help me. And so that plateau, I almost had to force my way through it just to survive. I was way too late hiring help. Had I hired someone at 20 units like I should have, a part-time assistant or whatever, it would have been a lot easier to stomach this. But I was at such a overwhelmed state when we added this new building and the condition it was in and the problems we were having getting it up to speed we needed it. And of course, if you wait until you need the help, you don't have time to actually hire the help. So the thought of sitting down and interviewing people and spending hours out of my day doing that, I just didn't see where I could fit it in. So that was a really tough point in our business. What I tell people is I had a pretty good job at the time. I had moved into a different career. I was making good money. I had good benefits. I could just come home after work and sit and watch TV and go on vacation 3 weeks a year and call it good. I had created myself something where if I wanted to go up to a place without phone and internet for more than an hour, it was out of the question, let alone take a vacation or something like that. So I had created kind of this monster. It was a really tough time for us.
Yeah. So and it seems like you were at this point where some of the properties that you had bought in the past, especially this 24 unit, you were in the same position as the owners of that because you didn't have time to take care of everything that you needed to take care of. So I'm sure things were slipping through the cracks.
It was tough. It was, we were still striving to do the best we could. And the perfectionist in me wanted everything to be absolutely, I felt that if we got a call that, a sink was leaking, I felt like it was almost a shot at my own persona that we couldn't provide a nice enough house that things wouldn't break. I mean, I really started to take it to heart that we weren't doing the things, we weren't providing the housing, we weren't providing the product that we wanted to provide. So it was kind of a struggle at that point to, I didn't know where we were going to go about this. That was probably the first time I ever really thought about quitting.
Yeah. Well, had you looked into or considered third-party professional management?
So I had, and that would have been excellent had I just been able to go out and hire a management company and them take over. But unfortunately, the market I'm in, and I don't know if this goes for all over the country. I know there's horror stories, but the market I'm in, there was nobody that was up to the task. I had your average management company, there's 2 or 3 in the area to work with. Their average vacancy might be 2 months to lease a unit. That's just not going to work. It just seemed like I couldn't find a management company that could do it nearly as good as I knew we were performing. We were running, once we got that building up to speed and consistently, we run high 90% occupancy, 98, 99% occupancy. All our single families were running that way. So I had a few friends that had a couple properties they had with a manager, and they would tell me about 2 months to fill a vacancy where I'd rent a house right down the street in 2 hours or 2 days. So it's things like that. Some of the expenses that they would get baked in because of the if you have a leaking sink, they're going to send out a plumber. They're not going to send out a handyman. So that might be the difference between a $50 service call and $150. So those I couldn't find someone to do it, and I was really in a bind because of that.
Wow, is that how Epic Property Management was born?
That's how we were born. So we somehow found a way to step back and say, okay, we need help. We need someone to do this for us. We need someone to help with the day-to-day of this. It's overwhelming, and there's no point. There's no point in me getting into this industry, getting into this investing if all I'm going to be doing is answering phone calls and running around to showing units and just generally, living a hectic life for it. I could have just kept a regular 9-to-5 style job and gone that route. So we hired an assistant, and it was tough. Hiring the first one is by far the hardest, but also the best move I ever made in this business. Probably the single-handed best move I ever made. And we got someone who was part-time to answer phones. We would forward the phones to her cell and to do showings for us. And just generally, I started making a list actually of everything that I did on any given day. And then I'd try to sit down and look at that list and say, what can I possibly teach this person to do? And so that's what we did. We had one person that started helping. And from there, the light bulb went off, and we knew that hiring these things out and putting these systems in place was how you actually grow this business. And plus, it makes it much, much more enjoyable. I absolutely love investing, but I really don't like answering tenant phone calls when there's a maintenance problem.
Yeah, a lot of people who are do-it-yourself and manage their own properties find it very difficult to delegate to someone new.
Right.
Because the feeling is, well, I can just do it myself quicker.
Right. And I'm actually, I'm still working on that. I mean, I'm definitely a perfectionist, and I'm a hands-on. I like to do it myself. And a book I'm reading, I don't know if you've read the book, Procrastinate on Purpose. I highly recommend it. Just recently was reading it. In that book, they talk a lot about delegation and ways to scale and build systems. But the reason there's usually two main reasons that people fail to delegate. One is they don't think they have the money to do it, to hire someone. They can't justify the cost. And number two, and probably a much stronger reason, is they don't think anyone can do it as good as them. But truth be told, when looking back, yes, there are definitely mistakes that were made from people that we've hired that I probably wouldn't have made on my own. But I also wouldn't be above 50 units right now if I hadn't started hiring people. There's just no way. In fact, 50 was probably overkill. Probably about 30 was where I would have ended up stopping if I didn't just have my portfolio double overnight.
It is Epic Property Management. Is it just managing your properties, or do you manage other people's properties as well?
No, we manage other properties for other clients. In fact, we've been focusing on growing that area of the business over the past 12 or 15 months or so, and that's been a really strong growth point for us. But it did all start with my properties, and actually that's really our core value, is that we understand real estate and we understand the pain that happens when you have a maintenance call and you spend 3 times what you need to because the wrong vendor went out. We understand the pain that an investor feels when there's a vacancy that lasts 3, 4, 5 weeks or even more. And so that's really been the core. We're built on those core values of what I know my portfolio couldn't withstand. And we try to pass that on through all the properties we manage.
Okay. And at what point then in your investing did you actually deliberately create Epic Property Management?
So after we hired that first, she's still with me today too. After we hired Regina, our first assistant office manager, the only employee we had part-time here, it did a couple things for us. One, it took some weight off our shoulders, which was great. Definitely a little more breathing room here. Number two, which I didn't see coming at the time, but it actually made us more accountable, because it's funny how I can do something day in and day out myself, right? And I understand how the process is. For example, my bookkeeping was all via Excel. I had Excel spreadsheets that were so complex that it was insane. They did some really great things for us, but only I knew how to use them. If somebody went in there and deleted one cell out of that Excel sheet, the whole thing would just self-destruct, right? So that's a problem. And I quickly realized that now I need to actually build a system, because I've got somebody that I have to teach. I have to make a repeatable process here. So that is kind of what the birth of Epic Property Management was. That was the very, the beginning stages of it. Was we started realizing we need to do things more professionally, because I had to, well, I'll get into that in a second, but systematically, we had to start doing things more systematically, right? So I could train them. The other aspect was it actually held me accountable. It made me do things even more professionally than I wanted to, because it's one thing if I take a phone call and a tenant says that, hey, my cabinet door fell off, and I say, well, I don't want to spend $5,000 on a new kitchen for you, so we're just going to go screw that cabinet door back on. But it's a whole nother thing when my office manager says, hey, this tenant called, or my assistant, whoever she was at the time, she's now my office manager, so you'll hear me refer to her that way. But when she calls and says, hey, this tenant called up and they're having a problem, their cabinet door fell off the hinges. This is a real life one. And the real life thing that I said to her was, well, let's just go ahead and fix it, because we don't want to spend $5,000 on that. And as soon as I had to say that out loud, and I wasn't talking directly to the tenant, so I could speak a little more frankly to her, right? As soon as I said that, I thought, who am I? I am not the investor that is going to slumlord these properties. I'm going to do this right. And so having that other person that I had to answer to, even though they work for us directly, and having to say that just gave me this third party view of it. And I thought, no, we're not doing things that way. We need to be accountable here. We're going to go in and we're going to replace those cabinets that should have been replaced 5 years ago. And so that was actually that original quote unquote turnkey property that I'm referring to here. So it all comes full circle. So it held me accountable for the decisions I made, because they had to be honorable decisions. And to be totally honest with you, if you have no one looking over your shoulder, I think a lot of people have an easier time making a decision that might not have as much integrity involved. When you have somebody looking over your shoulder, or that you have to explain this to, you start to realize how ridiculous it sounds if you want to do something a little bit on the less professional scale. So it was great for our business in that sense, but it forced us to put systems in place too.
And going back to the Excel spreadsheet, I've certainly seen a lot of people who self-manage and they create their elaborate Excel spreadsheets.
Yeah.
And of course, when I go to buy those properties, I'm the one who has to decipher them and pull my hair out.
Right.
Did you switch over to a professional property management software system?
We did. Probably short of hiring a person being the best thing I've ever done, probably the very close second was putting a property management software in place. So we use one called Buildium, which is a pretty popular software in the industry, but there are numerous other companies that can do just the same.
What's it called? Buildium?
Buildium, yeah. Buildium. I really, really highly recommend Buildium. We love it in our business. It's the core of our business now. But there are others, Appfolio, Rent Manager. I'm sure that you use one yourself, I imagine, right?
I use third-party property management, and they use
Even better. Appfolio, right? Very common. So we switched over to Buildium. Again, way too late, because once you have 50 units, now that's 50 properties you need to input, and while all these properties are running every day, you need to learn this software at the same time. So someone pays rent and you're trying to figure out how to put it into your software. So it was really, I did myself a big disservice by waiting so long to get this software in place. So what I always recommend to newer investors now is, it's not going to help you when you have 1 and 2 properties. You really don't need software. Don't waste the time, the money. But once you get 5, 6 properties or start to grow this portfolio to that size, start with the management software then. And that way, when you do get to 20, 30, and 40 properties, you won't have this huge learning curve while you're trying to run your business as well.
Yeah, absolutely. And I would add to that if you have any intention of doing a cash out refi or selling your property, having professional records that are kept on professional management software is much better than presenting elaborate, weird Excel spreadsheets that don't make sense to anyone but you.
Oh, the amount of time it has saved me once we got over the initial learning curve, the amount of time it has saved me in just the fact that I can run a rent roll on any portion or entire portfolio with a click of a button. I can run a financial report for year to date, month to date, quarter to date, you name it. You can customize. The reporting is awesome, and it looks more professional to banks and lenders, but it's also much easier to generate. So it helps with tax preparation. It actually, what I really like about the software is it helps with accountability. When I was on the Excel sheet program, if we spent $20 somewhere, if that receipt got lost, it didn't go in. But with a property management software, it can reconcile directly to your bank account. And so if a receipt doesn't get entered by someone in the office, then our software will flag us and tell us that we're missing a transaction and how much that transaction was. So it's really nice that there's no more worry about things not getting recorded.
That's good. There's some redundancy and backups in there that they can help keep you accountable. Is it also accessible and viewable online to your owners?
Yes. Yes, it's fully in the cloud, and then we run our office now with a fully electronic filing system. So we can pull up a receipt from 3 or 4 years ago. We scan everything in. We can pull up a receipt for $4.10 from Lowe's 4 years ago and see what we bought, and it actually comes in really handy. You can do that from your as far down to your cell phone if you wanted, from anywhere in the field. It comes in pretty handy.
Very nice. And as far as Epic Management or Epic Property Management, how many properties do you manage?
So right now, for other investors, we manage about 65 units today, maybe pushing 70 today. We really just started to grow that portion of the business about 12 months ago, but we really ramped it up beginning of this year. We're still kind of niche in that for a couple reasons. We only manage certain geographic areas, downriver areas, and the suburbs. We don't go into Detroit, or the areas we won't invest in, we won't manage in. We do that for a couple reasons. One, I don't feel that I can do a good job for an investor if I'm managing in a city that I don't have any relationship with, and I don't have any knowledge of the workings of the city. Each city around here is very different in how they do things. Their inspections are different. Their staffing is different in the city hall office. The person you need to talk to for this issue is different. So for one, I don't do it because I don't want to give ourselves a bad name if we can't do a good job. For two, I don't do it because they're really hard to manage, right? So a property in a bad area with a bad tenant that you got into for $5,000 that looks like it's going to cash flow on paper really well, that is going to be a management nightmare. And honestly, I just don't want to handle that for you. The reason that I put so much money into my properties is because it helps with that management aspect as well. So you get a really nice tenant, it's very easy to manage. It's actually the reason we do our pricing structure the way we do as well. It's ironic that somehow property management somehow got based off a percentage of rent, because I think anybody would agree it's probably easier to manage a $2,000 a month rental than it is to manage a $500 a month rental. The clientele you're dealing with and the quality of the property makes it such that the management's easier. So why should that owner pay more because they have a higher dollar rent? So we charge a flat fee, $79 a month management.
Let's talk about that flat fee, because that's you're one of the few companies I've seen do that. And the company that manages my properties, Green Property Management here in Grand Rapids, they actually do a flat fee structure as well. And it's a very unique flat fee structure. And in fact, it sometimes causes problems with the banks, especially when we're going for larger loans with like Freddie Mac or Fannie Mae, and they don't it doesn't fit into their box. They don't understand it.
Right.
But let's talk about yours, because it is unique. What does it include?
So we include a full suite of management services, which is anything just like probably every property manager out there. It's going to be anything from advertising the unit to showing the units to leasing the units to putting the tenant in place to collecting rent to coordinating maintenance, and every aspect. If a tenant has a payment issue to eviction proceedings, we have two fees essentially. We have a $79 a month flat fee, and then if we do place a tenant, we have a $500 per month lease up fee. And that's it. That's across the board. There's no markup on maintenance. There's no markup on eviction proceedings. There's no other charge on it. So it's just simply if we place a tenant for you, a lease up fee, one-time flat fee, and then a $79 a month management fee.
What about a releasing fee?
We structure our leases that they are starting as 12-month leases, and then they revert to month-to-month leases there going forward. If we ever need to regenerate a lease for whatever reason, either to increase rents or to whatever that is, we don't charge for that. We only charge the lease up fee. It's actually almost a break-even fee for us behind the scenes here, but it covers our leasing agents going out and actually showing the property. So we have to somehow offset that cost. But unless we place a tenant, we don't charge that fee. And then if that tenant that we place doesn't fulfill that first 12-month lease for whatever reason, we release it with no lease up fee as well. So it's a little bit of a guarantee on that.
Okay. And as far as maintenance goes, you don't tack on the 10% upcharge. Is that
we
what
don't?
You're
And that's one thing where I do believe you can almost offset our management fees just by the maintenance savings we get. So we're going to use, since we do manage in a fairly tight-knit area and the same style properties over and over again, the discounts that we've started to negotiate in with some of these vendors, whether that be the local big box stores that the local Lowe's, we're the largest buyer at the store that we're at. So we've managed to secure some fairly good discounts there, down to the plumber we use that we call him 3 and 4 times a week. These vendors give us a little bit special pricing, and they also give us preference on getting out there. So when you've got the great flood of 2015 happening that we had a couple of years ago, and everyone's scrambling to get plumbers in their house, we're able to get somebody out because we use them over and over again and at a very good price. So we pass that on directly. We also have an in-house maintenance, a full-time maintenance man that drives around in a company vehicle that we bill out at very marketable rates too, just enough to cover his cost. So that tends to save money for the owner over time.
And if the unit is vacant, are you charging that?
We're not. We only our system automatically charges that fee as soon as we place a tenant in that unit for you. But if we have, that's usually not an issue because we do pride ourselves on running a top-notch management here. And if you have a vacancy that's over a couple days, we've got a problem and we're talking to you about it. In this market right now today, we are consistently leasing a property within 1 to 4 days.
Wow, that is fast.
This thing goes over a week, and we're talking about maybe we have the wrong rent amount in here. Maybe we need some upgrades. Right then and there, if we can save you a month of vacancy over another management company, then right there we paid for your fee for the year.
Yeah, absolutely. What so for people who are in Southeast Michigan listening to this, wondering if you can manage their properties, what are the cities you are managing in?
So we're managing in essentially any suburb from 696 south. So starting Livonia, we'll go into Redford and those cities. If you move south all the way down to Monroe, which is Monroe County. So it's a pretty big geographic area. We do not manage in Detroit, Inkster, Melvindale, River Rouge. Because of the quality of properties that some investors have in there and just the difficulty, we really can't do a good job for you in there. There are other companies that can, but we're geared more towards that higher end clientele.
What about the Plymouth, Canton, Livonia area?
Plymouth, Canton, and Livonia all fall right in there, and we go as far west as almost to the Dexter area. So basically the entire Southeast Michigan metro area. We don't go too far north. Once you get above about the Livonia, Redford areas, Warren, we do a couple in Warren as well. But once we get north of that, again, it gets a little bit geographically of a challenge, and we don't have the vendors up there that we use regularly down here. It's harder to get our in-house maintenance to run an hour away for a service call, so we can't do as good of a job for that owner. If we go too far away, it gets to be tough to do a good job for that owner. And I feel like over time, if we're sending a vendor that we haven't vetted out to a property that we're managing, we're doing a disservice to them, and I don't want those owners to incur expense because of our lack of experience in that area. So we just have to pass on those.
Let's get back to your portfolio. And I like this idea of the plateaus. You reach different plateaus. And you reached one where you said you were, about 50, 60 units in and just overwhelmed with managing the property yourself. To overcome that plateau, you brought someone on staff and started building a team to manage. Where did that take you next in your investing portfolio?
That basically took us to explosive growth. That is where as soon as we started hiring people, the portfolio just took off. So we went from 50 units to 130 units in a year. We added 80 or 78 units total last year alone. It was the first real year of having people on staff. So what that did for us was it took, just like you always hear, I know you've heard this before, but I had heard it, I just didn't believe it. But if you take yourself out of the day-to-day, like I did by hiring, and we hired a couple other people I can tell you about, but by taking myself out of the day-to-day, it freed me up to go look for money and to go look for deals. So now all of a sudden I was going and meeting with different banks, lenders, having lunch with lenders at banks, or I was going to maybe meet with brokers about a multifamily deal. I started to get more of those across our desk. I was doing the right things to work on the business, but not in the business all of a sudden. And it was huge for our growth. It just allowed us to go to the next level. I could never go back. I would never want to go back to what I was trying to do all by myself.
Yeah, it would be unmanageable at this point.
Right. You
grew your portfolio. I mean, you doubled it within a year. Talk about the properties you were buying during that period.
Moving on from that 50-unit portfolio, we had now someone helping in, admin role, and we started looking for more single families. I had more time to do that, and we started, we continued to pursue multifamilies. Somewhere along the way, maybe 20 or so more units, I brought on a project manager, and that role was, we started to again reach another plateau. We were out here doing still a lot of these single families, packaging them together once we get them financed and pulling the capital or recycling the capital out of those. So the money wasn't as big of a concern, but somebody's got to manage 4 and 5 rehabs at a time. And that is quite the chore, especially when you got a full-time job. So so managing those rehabs was now my next bottleneck, and I needed someone to do that. So we brought on a project manager, and his job was to make sure that these rehabs progressed on budget, on timeline. Once I took that off my plate, that was the thing that propelled us into that more explosive growth there. Because now I really didn't have any of this day to day to bog, my growth mindset down. And then we started just from there, just more single family properties. We'd buy, as many as we could get our hands on, package them 4 or 5, and as many as we did one package with 15, but it's usually anywhere from 3 to 6. We'd package them together, refinance them, reuse that capital to purchase other properties while they're still cash flowing under the new blanket loan. And then along the way, we had a deal brought to us, one of hundreds that we looked at, of a 53-unit apartment building. And this building, whole nother story, but it really kind of made my eyes light up because it was going to be so much easier than my 24-unit. This thing was 90 or 92% occupancy. It was making money every day. It just needed some CapEx into mostly the common areas and the exterior of the building. So that was kind of the next big growth phase we hit.
What were the numbers on that?
We purchased that at $1.65 million, and it was running about 90, let's call it 90% occupancy, somewhere around there. So I thought that it would be very easy. We would just take over and just collect a check every month and slowly, improve units as they turned over and whatnot. What actually happened was it was probably twice as hard as my first building. Ironically enough, when you have a vacant building, it's easy to go in and fix things up and put the right tenants in place because you don't have anything to start with. When you have 90% occupancy building and a bunch of the tenants were put in there without being screened at all, you got quite a problem. So we ended up going down to about 75% occupancy on that, to the point where it was almost break even. It was starting to be questionable if it was profitable. All the while doing extensive CapEx. Parking lot alone was a $65,000 project that had to be done basically day one. Common area carpeting on a building that size is $20,000. There's these big expenses, and all the while you're evicting tenants, either for non-payment of rent or for general nuisance issues, tenants that probably should have never been let in the building in the first place. So it was actually a lot more involved of a project that I don't think I could have handled had I not had help in the office.
Yeah, so you had your team to help you through it. It seems like you must have had to come in with a good amount of money. Well, how did you structure that?
I did. So that was, again, just a conventional purchase. We used a bank to finance 75% on that one of the, or maybe it was 80%, but we used a conventional bank financing like you would for multifamily purchase anywhere.
Okay, so traditional commercial 5-year balloon.
5-year balloon, yeah. It's
20-year AM.
Yeah, and occasionally we're able to get 7-year balloons now, but there always is that balloon in there, 20-year AM typically. Good rate, 4.5% or somewhere in that range. So pretty standard financing for that type of deal. The down payment, though, as I alluded to maybe in the last week's podcast, is once you get into these bigger numbers, that's a large down payment. So we had to bring to the table, we had some escrows we had to do for that property and everything with the condition it was in, and also some larger tax bills that we had to, be prepared to pay at closing. So we had to bring somewhere around $370,000 or $380,000 to the table, and it was all said and done. It was a big chunk of change. It just so happened that we were able to work some of our other. We had some flips that we were doing that we sold at the time. We refinanced some of our rentals that we had some capital tied up in. So luckily we were able to make the timing work. But that was about the biggest deal that I think I can do without bringing in other private money.
Oh, okay. So you took that one down by yourself then?
By myself, yes. And that's, okay. It's great. In one aspect, it's absolutely great that we can take that down by ourselves. But in another sense, it's very limiting because I couldn't do 3 and 4 more in a year that same size. We need some time to recoup from that, right? Or we need some other investors to come into the deal with us. And again, that one was not as good of a deal as the first one. Partly the market was more inflated, and partly you don't get those grand slam deals every day across your desk. But even that deal, we we turned down a lot of dogs. We really looked at a lot of bad deals to get even that deal there. And had I put other investors into the deal with us, we would have done very well with it. So that really made me realize that the next phase where you start to bring other people's money into it with you, you still need to have those really good deals. The kind of deal that you wouldn't buy, you can't buy a deal with someone else's money if you wouldn't buy it with your own.
Yeah, absolutely. And well, it also adds if you're going to use someone else's money, you have to make sure that the projected profit is going to be enough to make it worth their money and them taking the time to put their money into the deal and your time as well. So it's got to meet this. It actually has to meet a double threshold. Where is it worth your time? Right. And is it something that you feel confident you're going to be able to get your investors' money and the returns that they're expecting?
And the way I see it is, if you're going to bring someone else's money into this deal, you have to actually underpromise a little bit. You can't go shoot for the moon. If here's the scenario I'll give you here. If you're going to tell an investor, we think you can make 14% returns on this building, let's say, or on this investment, and they come in and invest with you and you make 12% returns, which is a great return, right? But 12% would be great by any means. But if you tell someone that they should be making 14% and they only make 12, you look terrible. Whereas if you tell them that you think we're going to make about 11%, and you come in and make 15 or 16, you look excellent. And if you can do that on a couple of deals, then I think that your pool of private money, your pool of investors is virtually unlimited at that point, because you've done what you've said you're going to do or exceeded those expectations. So that's my goal. That's why we pass, I think, on a lot of properties that maybe would work, because I want to make sure if we do this property, it is going to be a very good deal. It's going to be a slam dunk for everyone. Yeah.
So what's your sweet spot then? I mean, what do you, when you bring an investor in, what kind of return do you want to get for them? And then what do you want to get out of it too? Because you need to get paid.
Right, exactly. So if we're going to bring a deal in, so some of these deals we're looking to syndicate here that we've got across our plate right now, the return for the investor is projecting somewhere around the 16 to 18% range.
And when you say that, is that cash on cash? Like that's going to be their cash flow every year?
No, that's going to be their overall return. So the way that we project it out, I try to lay it out as simply as I possibly can. So we'll first look at cash flow. So cash flow is going to be the first part of their return, and that might maybe that's going to be 8 to 10% of that return. Then we're going to look at the equity buildup or the principal pay down of it, right? So the equity buildup portion is how much we can force those rents up by strategic improvements. Like I talked about on my first deal. So that might be on an average, when we're looking at now, maybe 4 or 5% if we're conservative about it over a 3 to 5 year period. And then the last aspect of that is going to be that principal pay down. That's going to be that note gets paid every month by all by the rent income, and that note gets paid down, and over time you've built up equity by paying down principal in that property. So all things combined, those are from our metrics. We're looking for something that targets the 16 to 18% range. We hope that it will be better. We hope that we're conservative when we estimate those, but we also understand there's things that could go wrong that could maybe make those returns not come to be. So when we won't go into a deal unless it projects that we're going to be in that 16 to 18% or higher range. And then we'll go and if we are going to pitch this idea to investors, we'll tell them to expect 12 to 14, especially the first couple of years.
Mm-hmm. And that 16 to 18%, that's the annualized return, which it takes into account the money the investor will be receiving as cash flow every year.
Yes.
The principal pay down, the equity buildup, and the appreciation of the property that can only be realized when you either cash out, refi, or sell the property after a period of time.
Right. So if we're going to distribute quarterly, you're not going to be receiving that amount of return in cash flow, let's say on a quarterly or yearly basis. It's going to be realized over the planned hold period. For me would usually be 5 years. For one, you need some time to stabilize the asset and let the principal be paid down, add the value you're going to add. So it's going to take a couple of years. This isn't as quick as a single family deal. You're looking for somebody that doesn't mind having their funds tied up for a little while. But for us, our strategy is, to hold everything long term. So what I like to do, if we can do this on an ideal scenario, is go into this deal in a couple years, it might be 2, it might be 3, 4 at the most, refinance that deal and pay off or pay out that investor's capital to the furthest extent that we can. So that way the investor gets a large amount of their initial investment back. And just like my deal we talked about on last week's show where I recycled all of my capital and then some on that first apartment deal, if we can recycle, a good portion or maybe all of that investor's capital and then still leave them in the deal as an equity partner, now they have an infinite return on investment. And how awesome is that?
Yeah, that infinite return, the holy grail.
Yes.
Which is doable.
It is. It absolutely is. And to do that, we're typically looking at value add plays, at properties where we can go in, and if it is, occupancy is good, maybe rents are really low, or maybe there's a strategic improvement we can make to each and every unit that will increase rents above where they are now. So we're looking for those plays where there is a little bit of value to be added, which I think that's really where that return can be increased over time. Really what we do is we rinse and repeat the same thing, but now we've grown our management side of the business. So now what I've realized is that in order to grow a large portfolio like in the thousands of units like I'm trying to target here, I think you need very, very strong management, whether that be third party like you're able to find, or whether it be, in-house. For us, the route is in-house. And so that's where we focus a lot of our business on today is improving the systems that we have and growing our team, putting the right people in place to make that management experience as good as possible.
Oh, well, let's talk about your team. I mean, who is on your team, and are you looking to expand your team?
Yeah, absolutely. So our team grew from the original admin, or we call her office manager now, that was part-time, and now she's become full-time. We added a project manager to help with those rehabs over time. We then started to have recurring maintenance that was just starting to be a bottleneck. So it was always identifying these bottlenecks. We hired a full-time in-house maintenance person, which drives around in a company van and basically rehabs or fixes units, whether that be a multifamily property or a single family or wherever it is. Then we started hiring more front desk, more admin help. So we have now 2 different admins that work various hours full-time throughout the week, and they answer phones, process rent payments, your general admin type, bookkeeping type duties. I've since then, we've hired a leasing agent to do the showings for properties, because that's quite that started to be a bottleneck there. So every time I identified a bottleneck, we would just hire someone to fill that role, which in turn ended up taking some of the hats that other people were wearing off. So, my original part-time assistant was leasing agent, was bookkeeper, was everything. Now she really just oversees the admins in the office. And so that's how we started to grow there. And most recently, I actually brought my dad on from California. He moved out here to a paid position this time, where he's a builder by trade. So he's doing some of our new construction projects that we're starting on.
New construction projects. Tell me about those.
So we got to the point as the market's gone up and up and up, and we've been putting nicer and nicer and nicer remodels on houses, that the numbers started to get to the point where I was starting to question how much they made sense, not from necessarily a cash flow perspective, but more from we could almost build this property from the ground up for what we're putting into it. So now that a lot of properties, as we target nicer and nicer properties here, a lot of them are costing 60 to 70, even 75, 80,000 to purchase that property, and that property still needed anywhere from $20,000 to $35,000 remodel, right? So we might be into this property for 100, 110, 120. We're getting a large investment into one of these properties in some cases now. So what the idea here was we could almost build a property for that. So if we have 110,000, let's say, into this property, and we did a really nice remodel, it's got granite, it's got refinished floors, it's got all new doors, and all it looks very, very nice. We could definitely, it's kind of like a very nice high end flip, and we rent that out. But that property still might have a roof that's 7 years old, that's in fine shape, but it's 7 years of life gone. Or it might have a driveway that, has a crack in it. It's still in good shape, but it's not brand new. Same with the furnace or some of these bigger ticket items. We don't do everything. We do what needs to be done and replace the things that have minimal life left. But the CapEx items that still have a lot of life left, we leave them. And my idea here was, if we're going to be into one of these properties for $110,000 and still have some CapEx that's not in perfect shape, we could build this property. And the original idea was build a small house. 1,200 square feet is about our standard rental property here, 3-bedroom, 1-bath. My plan was to build that, and we could build it for about that cost. Once we got into the planning phase and everything, that the size of property grew a little bit. But what we're able to do now is, for one, everything will be brand new. For two, we're able to put a little bit of, you've heard the word functional obsolescence before?
Mm-hmm.
So that's what happens. The houses we're rehabbing, they're wonderful houses. They come out very, very nice, and they're very high-end finishes. But they still were built in the 1950s, and back then they had smaller bedrooms and more closed off layouts, and there's only so much you can do to that. If a bedroom is 11 by 11, it's going to be 11 by 11. There's no way to make that better. So with building it from the ground up, we can encompass what people want today. So we can do a walk-in closet, we can do an open concept kitchen, we can do a 14 by 14 bedroom. And none of these are that much more cost to build than it would be if we built the old design, but they're much more functional for today's standards. So that we can do, 2 bathrooms instead of 1. And there's a little more cost there maybe, but it's so much more functional. So we started to design a property around what we thought would suit today's tenants. And we're already going to do a very, very nice remodel anyway, so we might as well just make it brand new. So our numbers, we're not done with them yet. Actually, we're just starting to break ground on 3 of them right now. But we're projecting that we're going to be able to build this for $80 a square foot as our target. And that's a little bit of a tough goal, especially right out of the gate to hit. But if we can do it for $80 a square foot, the properties are about 1,700 square feet and change. It's going to be about $135,000 in build cost. So it's not that much more of an investment. We should see a little bit more rent out of those because just the size of the property and the functionality of it, that's just something we're trying out here.
That's an interesting experiment, and you've kind of run into what I think is an important signpost in the economic cycle of real estate, and that is we've reached a point, at least in your area there, where the replacement value or new build cost of a property is on par with what it costs to purchase it right now. So, in other words, why buy a house for $120,000 that has all kinds of issues that you're going to have to put money into when you can just build something new and have the same thing for almost the same price, only it's brand new and you won't have to do any repairs on it for 10 years.
I'll give you a couple disclaimers. We could be totally wrong. So this might not actually work. We might not be able to hit our build costs. There's a bunch of areas that this might not work, but it is a trial. We are still buying properties on a regular basis. We put 5 under contract in the last couple of weeks here alone. So we're still buying as well. But what we were finding is the higher end properties that we were buying, we think we were close to being for that. It's still going to be more. We're still going to have more invested when we do build these properties, but it will be the spread is narrowing on those. And then with the reduced CapEx, we think that will help. So if we can build them for the cost we are planning on, the numbers will just start to work, but it's on the cusp of working. The other side of that is we're hoping to build for $80 a square foot. That is with extreme volume discounting. I mean, just for example, we're starting with 3 properties at once. So when you go to the foundation company and you say we need a foundation in, it's actually we need 3 of these in. They're all 2 blocks apart from each other, so you get that volume discount. We're leveraging a lot of our vendors that we use in our regular rehab business to get these kitchens put in at prices that are investor friendly prices. So that's where we think we'll be able to kind of pull this spread closer together on what's existing and what's new. But I don't think the market is quite there yet. It's nearing that area.
To change the subject a little bit and go back to investing in single families and multifamily, A lot of people kind of come down on one side or the other. They prefer single families or they prefer multifamilies. You're still doing both.
Right.
What do you see as a difference between each, and why are you still doing both?
So for one, we manage our single families much like a multi. We buy them very geographically in a tight area, so it is not to run from one property to the next. You might only be going 2 blocks. So that's, in a sense, it's not too much different. But for us, the big picture is I don't want to be tied to one asset. I only flip houses. I only buy single family rentals. I only buy multis, because then I'm either not doing very many deals or I'm not doing the right deals. So this lets us just do whatever makes sense. If an investment makes sense, we're going to do it. So for us, that's just, it's been a flexibility that's allowed us to make good decisions and continue to make decisions and keep moving.
Where do you see yourself in the cycle that we were talking about from the beginning, which is that moving from 0 to 160 units, the plateaus along the way? Are you in a growth phase, or are you plateauing and looking for the next growth phase?
We're always trying to stay growing. I want to continue to grow this. My goal is to have 10,000 units or so under management. I want to be in the thousands of units, not in the hundreds of units. And to do that, I am at a little bit of a plateau in a couple of senses. Mainly now, it's back to a kind of a financing issue. Is like I probably mentioned earlier. If you want to buy a $10 million property, you're going to have to put $2.5 million down, or roughly that, right? And most people, even in a lifetimes of savings, are not going to amass $2.5 million on their own. So you're going to be bringing other people into these deals. So that plateau is finding the right investors that are looking for that longer term return, that want to work with us on these deals and, see our track record and see that they can benefit from this as well. The other aspect of our business, growing the property management side, there's always going to be growth there, because every 20, 30 units we add, we find another small bottleneck that we try to work around. And usually the workaround is hiring someone new for that role. So I'm sure we'll continue to grow on the management side of things. That's a little bit more of a steady growth. I think on the portfolio growth side of things, it's going to be more of an explosive growth as these deals, like a couple that I'm working on now, come along and we start putting these investors together. Instead of adding 1 and 2 and 3 units at a time like we've been doing, we'll be adding 50 and 80 and 150 units at a time like these deals we're working on. And that's where I think you grow the portfolio to that next level. And how are you finding these deals that you're looking at and that are going to take you to the next level? We're constantly finding single family deals. That's kind of just the day-to-day. That's like just breathing and eating for us. You find them on the MLS. You find them through wholesalers. Occasionally, we'll even get people just calling us directly that want to sell a property. We don't advertise for that, but we're so tight-knit that they see us around here. So those just kind of come to you. The multifamilies, that, as you probably know, that takes a lot more coaxing here. So we have a couple different brokers that we're on good terms with, and these brokers are going to bring us the deals that they get listed, these commercial brokers. So they're going to bring us deals that they get because they know that we're a known closer here. We don't go into a deal if we're not going to close it. I don't think we've ever come across even a single family deal. If we sign a contract on it, we're closing that deal. And I think if I was a commercial broker, that's the kind of buyer I would want, right? I don't want my commission to hinge on somebody who might change their mind later. So we just try to nurture those relationships and try to go out and build new relationships with brokers that might have listings that might make sense for us and for our model. We love that property that needs a little bit of rehab, that needs a little bit of management, TLC. And then I also wanted to ask you about the economics of owning your own property management company. Do you see Epic Property Management as something that's generating revenue for you as a business, or is it more a means to growing your portfolio? It's definitely a means to growing our portfolio. In fact, we are virtually a break-even company. When you're bringing in a new property, let's just say it's a single family to manage, and you tell the owner that we charge $79 a month, occasionally we'll get a response. $79 a month? That's a lot of money. Well, there's actually a lot of expense in this. So there's so much overhead in running a management company. I'm sure if you get to the right number of units with just the right staffing, there's a profitable area of it. But what I've found is that for every time that we reach one of these bottlenecks and we need to hire somebody new so that we can keep up that level of service that we demand here, we need to bring somebody on for that. That adds more overhead. And so it's a very tough game to play, that every time we add units and increase our revenue, we also increase our overhead by adding more staffing or more better systems that do cost some money. So unfortunately, I don't think the property management thing is ever going to be a get rich type business, but it is a necessary business for us to instill that professionalism in our portfolio. And if we can grow this management company alongside growing this portfolio, it lets us have so much more control over the end product that we're producing here, that I think that's the main goal of this management company. And so we're happy to manage for some other investors and bring them along for the ride with us.
And what advice do you have for other investors, those who are looking to get past the plateaus that they're stuck on and grow their portfolio much the same way that you have?
First of all is just get out there and go for it. I mean, it depends on what plateau you're on, but virtually every time you're stuck, it's because of inaction, whether that be that first property that you just need to, the next actionable step is go write an offer on 5 properties today. Or it be to that level where you're at 30 or 40 units and you need to hire somebody and just go out and put an ad on Craigslist and on monster.com and just start interviewing people. Just put the next step in place, put the next foot in front of the other and do something, take some kind of action, because most people that are stuck, they're stuck because they have a mental block on it and they're not actually taking action.
Great insight from you, and I really appreciate you taking the time, not just today, but last week's episode as well, to just share what you're doing. I mean, you have so much transparency to the way you approach real estate and investing and managing that I think our listeners are really going to appreciate and get a lot from. So thank you so much for taking the time to talk with us.
Thank you very much for having me. I love real estate. I love investing and what it's done for me personally and for our business over the past 7 years. I love to see other people succeed in this industry as well, and it's very doable. Feel free to reach out to me anytime. I really do love helping people get going in this at whatever level they're at. I know it's I get a lot of joy out of seeing other people succeed in it as well. And you can reach out to us on the property management side. Our website is Epic, EPIC, propertymanagement.com. epicpropertymanagement.com, or you can shoot me an email directly if you've got any questions for me, and my email is josh@epicpropertymanagement.com.
So before we go, I want to take a moment and talk about the Rental Property Owners Association. And if you've been listening to this podcast, you know that a lot of the guests that I've had on this show are members. And as a member myself, I can tell you that the RPOA provides a lot of value, not just to me, but to all Michigan rental property owners and real estate investors. And right now, they are offering a 50% discount on first-time memberships by calling this number, 616-454-3385. And you can call that number Monday through Friday. And if you mention this podcast, you'll get a 50% discount on a first-time membership. And once again, that number is 616-454-3385.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.